Hello. Today I want to talk to you about how to obtain funding. The name of the game is venture capital, mezzanine capital, project funding, startup funding, equity release, corporate loans, whatever. Simply, it's about money. Everybody wants it, but only a few people actually know how to get it. Or better, I should say, how to deal with investors and the investment community. No other business is surrounded by so many myths as the world of finance. While obtaining capital could be a piece of cake if you only knew how investors think or work, most project funding fail because the person applying for funds, not because of the project. In corporate funding there are three phases. Phase number 1, knowing the investee. Phase number 2, knowing the project. And phase number 3, understanding how the operational business works and how the investment will be paid back. When you are hit for money, you want to know the person you are lending the bucks to. And the same holds true for the investment community. That's why successful investees know that the first step is to provide a meaningful background about the project initiators, and such a background has to cover their personal, professional background and their financial background. The reason potential investors want to know is simple. A. They want to understand if the investee is professionally capable to successfully manage the project, and B. They need to know what sort of capital is required and what the risks involved are. Many applicants feel uncomfortable laying out their personal financials, but you can't expect to borrow millions if you're not prepared to tell about your own financial situation. The trick is to be honest. If you don't have any own assets to bring in or you don't have a high income, that doesn't have to be a killer. After all, venture capital does exist for this very reason, and if all entrepreneurs would have sufficient own assets, there would not be an investment community. The second phase is to describe the project. Typically, the project, property or asset to be acquired or to be built will be provided as a security to the lender or investor or shareholder, so it's important to provide a good description of the project and to support it with evidence, such as deeds, planning permissions, letters of interest and other relevant documents. The more detailed you are, the higher your chances for a quick and smooth funding transaction. By the way, typically it takes 5 months to find and complete funding, although deals have been made as quick as 2 months and as low as 18 months. But everything depends, of course, on how quick you respond to requests for information and documentation. The third and last bit of your proposal has to be the bit that shows how you intend to pay back the capital once the business is up and running. This is where cost, revenue and forecasts are key. Usually these 3 key pieces of information are compiled in a business plan, and often a business plan is the vital part of funding application. However, a business plan does not necessarily have to be a 100-page document. It is more important that a business plan contains the 3 parts as outlined, is comprehensible, plausible, easy to understand and honest. In principle, one has to understand that investors are people who understand figures, and they are not people who understand or even need to understand a specific industry or business. So the first mistake is to present them documents that contain shop talk, jargon or highly technical descriptions. If you present a proposal that meets these criteria, you have started on the right foot and your chances for funding are far above average. Good luck with your project, and until next time.